Well, for some thoughts on what's in store for 2025 in terms of what's moving international markets, we do have on the line with us Mish Schneider, Chief Strategist with marketgauge. Mish, good morning. A happy new year to you. Thanks so much for joining us. So if we take a look at how U.S. markets performed in December, it did appear that they lost some steam as we head into 2025. What do you think were the factors contributing to this sluggish performance, which some would say was quite unexpected?
Well, first of all, Happy New Year to you guys. Yeah, I mean, unexpected, I think, is part of the reason because everybody anticipated that there would be a seasonal rally or a Santa rally, but instead, really, it stopped with the Fed. When the Fed came out and said that they were only going to cut twice in 2025, they called that the uh, uh, a hawkish statement, actually, if you know, in terms of a hawkish cut is really what they were calling it. And so there was that. The higher yields, of course, we saw in the market. We saw the dollar rally. We had obviously some profit taking coming in. There's a lot of uncertainty about what's going to happen in the new administration. We had some statistics come out that showed shrinking manufacturing areas and essentially, yes, it was disappointing, but was it disastrous? No. We will really have to see how we start this year and what we do in the next couple of weeks before we can determine what the first quarter is going to look like.
Happy New Year to you as well, Mish. But I was just wondering, if you look at the Nasdaq, it seemed to be the only major U.S. index that had a comparatively strong finish to the year, but the Dow did not. I'm just curious about what you might read into this in terms of the concerns over this divergence and how the overall U.S. market might perform.
Well, yes, the thing about NASDAQ and the Mag 7 is that it's somewhat impervious to the factors that we just talked about. Really, in terms of interest rates, it doesn't seem to be particularly interest rate sensitive. In terms of any particular new policies with tariffs, for example, won't necessarily impact the NVIDIAs of the world. And there's still a tremendous amount of bullishness when it comes to tech. As we know, AR will continue to evolve, even though not every company will do well, because we saw a couple of companies like Advanced Micro Devices, for example, really have a terrible year. So essentially, that will only sustain insofar, though, as that we have to see the Dow stay in the game, or we have to see, even more importantly, some of the broader areas of the market, like the small caps, stay in the game, because that will really be the areas that will be most impacted, not only by interest rates and a stronger dollar, if that maintains itself, but also any potential changes in policy, and then how far those changes go in policy to really make a difference, either both positively and negatively on the economy.
Mish, I want to ask you about asset allocation, because if we look at the S&P 500, this is the fifth year it has actually ended on a very good note out of 6 years. And in fact, it's been so rare that you have two consecutive years of like such gains, like above 20%. The last time was in 1997 and 1998. So what should an investor do? Because you think everything eventually should revert to the mean. Isn't it time for a correction?
Well, it's a really great question. And actually, what you're sort of quoting is the Case-Shiller point of view in terms of PE. And essentially what Case-Shiller is projecting, when you've had about a growth of about 37, 38% like we've had, is that the next year, and in that case, they even say the next decade, although we don't have to look quite that far out, growth will only be about 3 to 4% in terms of how much the S&P will gain in 2025. And I think that's probably a good, realistic indicator. Now, if you listen, though, you'll hear people think that the SPY is going to 7,000, and then you have others who think it's going down to 4,000. So I'd say in that asset allocation, my best advice, and this is something not only am I telling people, but I'm also taking my own advice, is that in new administration years, you've heard the term January effect. We take it one step further. We call it the January trend trade. And the first 10 trading days of the year, a range is established. In anything, it doesn't matter what you're looking at, whether it's an index, Bitcoin, a commodity, everything develops this range. And then really what comes out of that range will probably tell us a lot about what's going to trend well in the first quarter. And if it breaks down under the range, of course, then we know we could be in for a much harder first quarter. And that's how we're looking at it. Everything, really. I mean, we have our favorites that we're watching, but we don't want to get overly involved until we see that range reconcile. And in 2024, by the way, SPY broke out of the January calendar range and literally never looked back. It was kind of easy money.
So, Mish, I mean, like you said, it's the first 10 days are going to be indicative of how markets will trade for the first quarter. But what is your sense of 2025 overall? I mean, the consensus seems to be that it's going to be bullish for U.S. equities. Are you of the same view, or are there certain headwinds to watch out for?
Oh, there's definitely headwinds to watch out for. I mean, and it's funny, there are people who are very bullish, but I also get a lot of questions and concerns from people who are terrified about what's going to happen next year. So you've got both. And this is why I talk about that January trend change, because it gives you a way to be dispassionate in terms of making your decisions. In terms of my personal point of view, even before I saw the case Shiller, I felt that we were definitely going to walk into a volatile first quarter, at least as we get through January, February. And that actually what I think could happen is that the Fed will be much more dovish than they're indicating, and that they will go back to being data dependent. So they'll be looking at PCE and inflation. They'll be looking at the labor market. And possibly if they start to see things unravel, and let's not forget, GDP was up mainly because of government spending. Trump is threatening to eliminate a lot of government spending, while at the same time he's also talking eliminating the debt ceiling. We don't know what the impact that's going to be. My sense is the Fed will try to deal with that, and then we can either have a potential recession, stagflation, or we still manage to wind up with that soft landing. And I know that sounds like indefinite in terms of what I think, but I really believe that you have to be very, very flexible and very active in terms of how you're looking at things. And if we have some really good super correction, probably will be a great buy opportunity.
Maybe if we could look at gold for a little bit, it rose more than 27% in 2024, the most since 2010. It hit a high of, significantly above $2,700. It's about 26, 25 right now. What do you think were the factors driving up gold prices last year?
Well, a lot of it was a flight to safety, and that was because even though the Fed cut, they didn't really cut till the second half of the year. So you had concerns about the impact of the interest rates. Central bank buying, particularly globally, was very, very strong, China being right there at the top of the heap. And also, gold was really, I think, a reflection of the fear of what could happen if inflation comes back. And we're still seeing that as a potential prediction. I mean, I said stagflation, so let's talk about that. Gold has already gone up to a degree. It is consolidating here at a very strong level. And if it stays above this sort of 2550, 2600, and anything happens where we see more cracks, whether it's geopolitically, whether it's weather, supply chain, or bad policies that spook people, you'll see gold go up to 3,000.
Mish, thank you so much for speaking with us, and we look forward to more conversations in 2025. That was Mish Schneider, Chief Strategist with MarketGauge, giving us her take on the trends to keep an eye on as we start the new year. 3,000 US dollars gold is a level that she says is not
implausible.
It's not implausible.
Yeah.
That's right.
Wow. Okay, but the point is pay attention to the first 10 trading days of the year. It's called the January trend trade. So that will probably give you an indicator of how 2025 will be like for the rest of the year. So